Hey, hi, this is Gautam. So in this video, I'm going to cover the basics of the three financial statements, the balance sheet, the income statement, which is the P&L, and the cash flow statement. And I am also going to build like sample financial statements and show as to how the three statements, they move together, how they're linked together. Uh, so this video would be less of theory, less of Kyan, and would be more of me being hands-on on a spreadsheet. And I like to keep it short. Okay. And so this video should serve as the foundation for anyone who wants to say learn financial statement analysis and equity valuation, which are the two topics which I am planning to cover next. Okay? And I'll start financial statement analysis and equity valuation for one industry, and then I'll cover different industries. Okay. All right. So if you are someone who already has a good understanding of the three financial statements and how they move together, you can skip past, move past this video, and perhaps you can just take a look at the financial statement analysis video, which should be up, soon. Okay. All right. So without further ado, let me get started. All right. Let me share my screen. All right. So first, let's talk about balance sheet. Okay. So balance sheet is a financial statement that summarizes that as of today, what you owe, okay, and what you own. Okay. All right. Say, for example, you started a business 5 years ago. Okay. So balance sheet will tell you that as of today, how much money you owe cumulatively, okay, and to whom you owe the money. Okay. So that's one. And second thing it's going to tell you, it's going to tell you how much equity you have in your books. Say 5 years ago when you were starting out, you put in some of your own money in the business. Okay. And over a period of time, you made profits. So those profits, they get added to equity. Okay. So it's going to tell you that over this 5 year period, what's the overall equity that you owe as of today. Okay. And third thing it's going to tell you is using these sources of funds, the money you owe and the equity, okay, what you own as to how did you apply, how did you use the sources of funds to build assets. Okay. All right. And so again, so balance sheet is at a point in time, it shows you the cumulative value. Okay. All right. That's important. In fact, that's the important distinction between balance sheet and P&L and cash flow, besides all things. All right. So, all right, now let me just walk to the P&L structure, and then obviously I'm going to cover them in more detail. So P&L shows you how much sales you've done, the costs you've incurred, and how much profitability you've generated over a period, for a period, within a financial year. Okay, that's an important distinction I said. And cash flow, again, cash flow is for a period or during a period. Will show you the cash transactions that your business has had during a period of, so it's easier for businesses to fudge P&L. Okay, they could perhaps have aggressive profitability. They could be reporting profits aggressively, but it's difficult for them to fudge cash flow statements. Okay, so it's very important that we always check the cash flow statement, okay, and not just rely on profit after tax numbers alone. Okay, all right. Okay, more on that later. All right. So now let me build a a sample, very easy to understand balance sheet, P&L, cash flow, and how they move together. All right. Say you are starting a business and you take you take some debt of say $1,000, you put in your own equity of say again $1,000. So how much? What's the source of overall source of? It's $2,000. That's the amount of money you have. So in the application of fund on the asset side, right? Or let me say cash, you'll have $2,000 worth of cash, right? That's what you'll have. Okay. Say using a portion of this cash, you decided to buy a piece of machinery because you want to like build some products using your machine. All right. So you bought some machinery. Okay. All right. Again, that's an asset. See, machinery, you use, you purchase $1,000 worth of machinery. All right. So your balance sheet balance, source of funds, application of funds, balance. So with each and every transaction, your balance sheet needs to balance. Okay. All right. And you've not done any sale, not made any product per se yet. All right. Okay. So say this is starting of the year. This is starting of the year. Okay. All right. Now, what you do is you realize for you to build a product, okay, you need to, let me put this in. Okay. So you realize that somewhere down the line, you realize, you know what, you need some more supplies, okay, to make your product. So again, that goes on your books. Okay, and you say purchase $500 worth of supplies. Okay. Now, instead of using your own cash, you know what you think? You know what? You go to a supplier and tell that supplier that, and to you strike a contract, with that supplier that you would not pay the supplier right away. You're going to pay them later. Okay, so that's liability that you need to record in your books. Okay, that's a short-term liability. So that is account payable. So that is 500. So, and again, just to recap, you go to a supplier, tell them they're going to pay them later, not right away. Okay, so that's liability, $500. With that, how did you use that fund? You used to purchase some supplies to make some product, right? All right. Now, so this was sometime in the middle of the year, all right? Now let's move to the closer to the end of the year, all right? So let me do this, all right? And this is, let's say, this is end of year, closer to end of year, all right? Now so what you do is you make a sale, say, of $500 using this machinery and these supplies. Okay, so let's go to the P&L statement. Let's say you make a sale of $500. Okay, and let's say that you incur the cost of goods sold is $150. What cost of goods sold means is these are the direct costs that business incurs in making a product or providing a service. Okay, that's what cost of goods sold is. Okay, any cost which you can directly associate with the product you produce or service you deliver, that is COGS. SG&A is, these are like indirect costs. Okay, all right. So let's say you incurred, any labor costs or what have you, or uh, part of the labor could be within COGS as well. But let's just keep it simple for now. Let's say you incurred indirect cost of $100. Okay, all right. So your earnings, okay, just after netting of cost of goods sold in SG&A is 500 minus 150 minus 100. Okay. And the financial term for that is EBITDA, earnings before interest, depreciation, and amortization, because we've not considered any of it right now. Okay, all right. Now let's talk about depreciation and amortization, because you purchase some machinery when you were starting out. Okay, so you need to depreciate that asset on your books over time. Okay, so see, every machinery, every asset you purchase has a useful life. It's not going to last forever. It has a finite life. Okay, so you purchased an asset of $1,000, right? Okay, this is what you had purchased, right? So if the useful life is 10 years, you need to depreciate it over a 10-year period. Like every year, you have to expense $100 in your P&L. Okay, all right. So let me, assuming 10-year useful life, that's your depreciation amortization. All right. Now, earnings before interest and tax after netting off depreciation amortization is again 250 and it's 100. Simple. And I know many of you guys know all this stuff already. That's all right. So this is a bit. Now let's talk about interest, because you took debt. You have to pay interest as well, right? Say towards the end of the year, let's say the interest is 8%. All right. So 8% into what uh, debt. Okay. Profit before interest and taxes is 70. So for 500, we left at $70. Okay. All right. Now taxes, you need to pay say 25% tax. All right. So 25% into 70, this is the tax you will pay, 17 and a half. All right. So your PAT or net income after removing all of these things is you're left with 52 and a half. That's your profitability for a period. Okay. All right. So what happens to this profit? Okay. So by the way, right now, let's assume for a moment, when you made the sale, you got this money from the customer in your bank account. Okay. All right. That's the assumption, and we'll change this assumption later on. All right. So for now, you got this 500 worth sale from in your bank account, and from that you made $52.5 worth of profit. Okay. So this 52 and a half will get added to your equity. Okay. Right. Because that's the shareholder money, or if this is completely yours. So yeah, this should get added, right? So this 52 and a half gets added here. Okay. Obviously the balance sheet won't balance. Now let's look here. All right. Machinery. So in machinery, this needs to reduce, right, at the end of the year, or perhaps starting of next year. Okay. Because it has a useful life of 10 years. So, and this machinery is already like sweated for 1 year. So you need to reduce $100 from it. Okay, because that has 9 years life left, right? Okay, so you got to show the amount which is equivalent to the life that the asset has remaining on it. Okay, so that's why you have to net the $100 off. Okay, all right. So again, the balance sheet is not balancing. Okay, and let's talk about supplies. So use some supplies and machinery, not just machinery, use supplies as well to make the product which you eventually sold. Okay, so let's net off some supplies. You in our P&L, we have taken 150, used 150 worth of products, or or raw material or supplies, okay, to make whatever products we did, then we sold them off, right? So we need to kind of net off this 150. Okay, so you have only 350 worth of supply left right now. So again, the balance sheet is not balancing. Just fine. Okay, it's right? Okay. So what about the cash? What about the cash? You definitely you earned some profit, which you added here in equity. Okay, but you should have earned some cash as well, right? So profit should translate to cash on this side. All right. So that needs to be added. And how we ascertain what's the cash? We cannot really just add 52.5. Okay. So just think about it. What is the cash? All right. So it is, let me go to the P&L. First, let me just add all the cash transactions here. Okay. And then I'll construct a formal cash flow statement. Okay. First, let me do it like quickly. Okay. So let's go to the P&L. I said we're assuming that you got this $500 from the customer. So you have to add that because you got it. It's a cash inflow. You got it in your bank account. But you need to net off SG&A because you had to pay your labor, or you had to you incurred some administrative expense in making that sale. Okay. And you also got to net off interest because you got to pay the bank interest. And you also got to net off taxes. Okay. So you got to net off all these things. You don't have to net off COGS the way we have treated COGS in our accounting, because you've already like considered in supplies. Okay. And then again, you don't have to net off depreciation and amortization because you've already netted this amount off from your machinery asset in your balance sheet. So you just net off these three items. Okay. Okay. And you see, you had $1,000 of cash. Now you have $1,300. So 302.5 worth of cash. So 302.5 more cash. Okay. And you see the balance sheet balances. All right. All right. So you saw that although you made a profit of 52.5, but the cash increased by 302.5. Why? Because remember, the supplier over here, okay, we've not paid him. So this is money which is still there with us, although it's not our money. We need to kind of pay this supplier. Okay. But still it is with us right now. So that cash is sitting with you. So that's why the cash is more than the profit right now. Okay. And we'll tweak this. We'll add some more nuances to it. All right. Okay. So now let's construct the cash flow statement. Okay. So first, before we do that, let's just, and this is the end of the year. All right. All right. Now let's record all the transactions that are taking place, and then we'll use all those transactions to construct a cash flow statement. All right. So the first one was issuance of debt. Second was proceeds from share issuance. That's proceeds from equity. That's just right. Okay. And then what we did, we used the source of funds to buy a piece of machinery. So it is purchase of property, plant, and equipment. Okay. All right. Then, so this was the third transaction. Fourth transaction was we took a credit from a supplier. Okay. So that is, this resulted in an account payable. So money that we need to pay the supplier. Okay. So it is change in account payables. Earlier we had zero account payables. We didn't owe anyone anything, but now we owe a supplier $500. So that is change in account payables. Okay. And then what we did, we used that money to purchase supplies. So basically we purchase of supplies. Okay. All right. Now, the sixth transaction is, okay, we depreciated this asset. Okay. All right. Because now this asset, this machinery has 9 years of useful life left. Okay. So we need to remove that 1 year of life that it has already like been sweated for. Okay. Right. So this is depreciation. That is the sixth transaction. Okay. And then what we did with these supplies, a part of these supplies, we sold them off. Okay. Uh, well, technically, we didn't kind of sold the supplies. We used the supplies to make a product. Okay. But it's akin to gain from selling of assets because we got this cash flow and then we use it to make a product. Just trying to stay consistent with the language that you would, or the headers that you would come across in the cash flow statement. Gain from sale of supplies. Okay. And what is the last thing? The last thing really is, as a result of all of this, what did you get? You made a net profit or a PAT. Okay. All right. Now let's put all of these transactions in a blank blank page. Okay. Do that. See. No. Jump around. All right. Now let's. What is the issuance of debt? 1,000. This is our source of cash. Okay. 2,000 totally is a source of our funds, which is cash flow from a cash flow statement. We call this cash flow from financing. Okay. All right. And now, purchase of PPE. All right. So there are two purchases of PPE. It should be purchase of PPE and purchase of supplies. Okay. Did I miss? Yeah, I missed changing account tables, I guess. So let me just put that in here. Okay. All right. Okay. So this purchase of PPE, purchase of supplies. How much is purchase of PPE? That's property, plant, and equipment. That's $1,000. And then this purchase of supplies. And by the way, this has to be negative. Okay. So in cash flow statement, remember, see when you issued, when you took debt, okay, the money came to you in your bank account. All right. So that's a cash inflow. When you issued equity, again you got money. Okay. So it's a cash inflow. Okay. Purchase of PPE, when you purchase, it's a cash outflow because money goes away from it. So you have to prefix it with the negative sign. Similarly, purchase of supplies, you'll have to prefix it with the negative sign as well. Okay. And now change in account payables. Okay. Change in account payables, it should be prefixed with a positive sign. Why positive sign? Because you did not pay anyone anything. You were supposed to, but you did not. That money, as I said, is with you. So it is a cash inflow. Okay, it's akin to a cash inflow. And depreciation, again, it's a non-cash expense. Again, it's just accounting. So you do not pay depreciation to anyone, right? It's the money is with you. Okay. So depreciation, I'm going to just write 100. So it's positive 100. Okay. And gain from selling of supplies, how much is it? Gain from selling of supplies is 150, right? It's basically 500 minus 350. Okay, because you sold 150 worth of stuff. And as I said, you actually use 150 worth of supplies to make a product. Okay, so it's akin to gain from sale of supplies, the way we've treated this particular line item. And then net profit really is, so as a result of all of this, you made a profit. Okay. So if you do all of this, so you total is 1302.5, which is the same thing that you see here. Okay. Here we calculated the net change in cash manually. Okay. But now I'm trying to do it uh, in a more structured way, in a way that you should actually do it when you like construct cash flow statements. Okay. All right. So these two guys here, these are cash flow from investing. See, cash flow statement uh, summarizes all the cash transactions that take place, in a period. So it has three things: cash flow from financing, where you get your funds from; cash flow from investing, so use that money to invest, buy a property, buy plants, or what have you. And then, so even this is part of cash flow from investing. Okay. And then these last three items, these are cash flow from operations. Okay. See, operations really, it's the business that you do. Okay. You got the money from financing, you use it to invest. Okay. And then as a result, you basically do your business. So all the transactions in which you do your everyday business would fall under operation. As a result of that, you got this profit. All right. Okay. Now let me just do a sum of all of these individual cash flow line items. Okay. And then let me see the net change in cash. Net change in cash from the time you started your venture. That's what this is telling us. Okay. All right. So as I said, again, 1302.5 is the cash that you have in your books. So this is what you see here. Okay. So as I said, instead of doing it manually, you've done it in a more structured way, using those the transaction names which you would typically see in the cash flow in a cash flow statement. All right. Okay. So now we are done with linking our the three sheets together. Okay. Hopefully this has helped you. Now let me throw another nuance. Okay. Remember, we had assumed that this 500. Okay. We assume this 500. The customer pays you right away, but it may or may not happen. The customer may pay you, say, just $100, and they may pay you $400 later. They said, you know what, I pay you later, perhaps in 6 months. Okay. So uh, you have to make adjustments now. All right. So if the customer uh, pays a portion uh, of the money they owe you later, then you got to account for that in your balance sheet and in your cash flow statement. Okay. So let me add a line item which is called account receivable. Why it's called account receivable? Because this is the money. You don't have it with you. It's your money. It should have been with you, but the customer has not paid it yet. So let's assume it's $400. The customer has yet to pay that amount. Okay. So you got to adjust this amount from the cash because you don't have that money. Okay. See, the cash dropped, right? The cash dropped. Okay. All right. Now, same adjustment, you got to do it here as well. Okay. Sorry, yeah. So go here, say change in account receivable. Okay. This number is 400. Actually, you should prefix it with a negative sign. Okay, because I said it's it's more like it's akin to a cash outflow. You don't have that money yet. Okay, so it's a drag on your cash. It reduces your cash. 1,300 something was your cash earlier, and now it has dropped to 900 because earlier we had assumed the customer had paid you right away, but now we are saying the customer did not pay 400 right away. They just paid you 100. So that's why we had to do this accounting adjustment here. Okay, and we had to prefix it with a negative sign. All right, so what a change in account payables and account receivables? These are nothing but change in working capital. That's what these are. Change in these combined, they show you the change in working capital. And what is working capital for us? Let's look at these two line items again: account payables and account receivables. Account payable is a current liability. Liabilities or your short-term obligations that you meet within 1 year. Okay. And your account receivables, these are your current assets. And current assets are, technically speaking, current assets are those assets, short-term assets, which you can liquidate and convert into cash in 1 year. Okay. So working capital is current assets minus current liabilities. And so working capital gives you a sense of how much liquidity you have, and you have sufficient money to kind of meet your day-to-day expenses. So basically liquidity. All right. So here, if we see this change is really change in working capital. All right. Okay. All right. So, and that's why it's important that you know what kind of payment terms you have with your customers, because it's going to affect your account receivables, and what kind of payment terms you have with your suppliers, because it will affect your account payables, right? And I know I did not consider inventory, but you can consider that as well. I just wanted to kind of show you as to how the three statements they kind of move together. All right. And yeah, if you have a lot of account receivable, your customers are not paying you in time. Okay. And but you need to pay your supplies right away. So what would happen is it would have a negative impact on your cash. So even though you could be reporting profits, but it would not be supported by backed up by cash, because you're not being paid, although you're reporting profits. Okay. All right. That's why it's very important to kind of check the cash flow statements and not just going by the profitability that the company is reporting year on year. All right. So, anyways, hopefully this has helped. Uh, if you guys have any questions, feel free to write to me. I'll be happy to answer any question that you have, and I'll be happy to provide the link to this spreadsheet if you guys need it. And so after this video, I would make a video on financial statement analysis of a healthcare provider, and then I'll follow it up with their valuation, and then I plan to do FSA and valuation for companies in other industries, including financial services like banks, insurance, and asset management companies as well. Okay, all right. Well, so hope this helped. So thank you.